My name is Ben Brandis. I'm an independent sponsor investing in age tech. That is products and services geared towards the aging market. My theory is everybody's aging. Try to dispute that. Yeah, exactly. And with me today, I have a great diverse panel. We're going to be talking about the M&A market. And I realize that's a broad market, but we'll try to get down to specifics, and we're happy to field questions during the actual panel. So let me start with people introducing themselves. From my left to right, Jeremy.
Thank you, Ben. Jeremy Swan, Managing Principal, Cohn-Resnick, responsible for the firm's financial services and financial sponsors industry practice. For those of you who don't know Cohn-Resnick, we are, depending on how you slice and dice the numbers, top 15, top 10. Try and get a little bit closer. I really don't like these things in my face, but make it work. Accounting, consulting, tax firm, spread across the U.S., some international offices. My practice is responsible for our private equity, private credit, VC, family office, hedge fund, bank, broker dealer, et cetera. Everything in the financial world practice across everything we do, audit, tax, consulting, including the transaction services with a heavy focus on M&A.
Chris Anci, is this on? Chris Anci, spent 20 plus years in financial services. The last 8 in particularly working as the CIO and COO of a family office here in New York. I am also president of a broker dealer where we specialize in private equity.
I'm Dashko. I'm a corporate and M&A partner in the New York office of Morgan Lewis with a focus on cross-border deals. I'm like sector agnostic, done deals in TMT, e-commerce, oil and gas, and other sectors.
Great. So you can see that we do have a diverse panel here of different expertises within M&A. But I'm going to hit this hard first. So Jeremy, this question is going to be posed to you. Allegedly, there was a debate last night, and there's a lot of people focused on what's going to happen in November. How will these elections, or do elections, impact the M&A market, and how?
We have 6 hours, right?
Sure.
So I will keep this very high level. Have spent a lot of time with a lot of our private equity, hedge, family office clients, as well as law firms, bankers, kind of all talking about the same topic. What impact does the election have? If you look historically, an election year is typically a down year for M&A because it's, there's just a lot of uncertainty. This year, the M&A markets, we were in a pretty rough spot. At the beginning of the year, it's gotten better. And we have a lot of different, heads and tailwinds at the same time. The difference with this election cycle versus past election cycles is, policy stances aren't really in question. Where you have 2 known entities, we know at least what the policy stances are from each side. At the same time, we have interest rates that look like they're going to start to move in the right direction. We have an economy that seems like it's holding in there and, geared for a soft landing if there's going to be any type of landing. And we have a, almost record amount of dry powder sitting on the sidelines. So we have, a lot of different factors right now that are tailwinds to the M&A market, and that we're going to be in a declining rate environment. We have decent, economic growth, not in all sectors, but, broadly based, a lot of dry powder, a lot of transactions that need to happen. And then, you have the, headwind of, okay, well, it's an election year, there's uncertainty, but there's less uncertainty today than there have been in prior election years because, at least we know, okay, if, the Republican Party wins, this is probably the direction we're going in. If the Democratic Party wins, this is the direction we're going to be going in. So at least there's the uncertainty of what the policy stances are. That's a little bit less this year. It's really more of a question of, what's going to happen, once we get past the election, what do things look like for the rest of the year going into next year, depending on, the outcome of that election. And depending on how much time you want me to spend on this, I can certainly get into, the theories around antitrust rates, Fed involvement, things like that. But I think that's kind of a lead up to where we are.
We'll have you go last. So interesting that you said, so good tailwinds behind us, but in an election year, M&A is typically down. So Chris, I know that in our prep call, you had mentioned that you use the term logjam within the M&A market. And what do you mean by that? And does this election, regardless of the outcome, get us out of this logjam?
Not to start off with a trope, but there's always the saying that you don't fight the Fed. And this was the most telegraphed interest rate increasing cycle in history. So if anybody got caught by it, then they certainly weren't paying attention. So the dramatic rise in rates and the speed at which they did that obviously affected, every aspect of the marketplace, including M&A. So, we came off of a high in 21, which was a banner year for M&A, and then we reached sort of, a bottom in 23. It's opened up a little bit here in 24, partly because when you look at M&A, it's a very large, obviously, segment for different reasons, right? So there's corporations that are serial buyers and sellers, right? You remember the old stories of GE bought and sold 800 companies under the Jack Welch years, in a given year, right? So there's companies like that because they're always trying to figure out how to buy growth because they're either too big, too slow, or not paying attention themselves, that they always have to buy the latest and greatest from whatever consumer expo they go to or however they need to grow their business. And then they divest of assets that are no longer performing. So that's one aspect of M&A, and that kind of drives the lion's share of top line size. Those are typically your multi-billion dollars. Particularly in terms of my logjam conversation that we had is for what we do, right, on our private equity business. We like the Series A round, and we go into small companies that have, some level of EBITDA, and we can get in at $30, $40 million valuation. They can grow that to a certain multiple. And then there's numerous funds or players out there that'll buy that company for $400 or $500 million. It's a great trade for our family offices and high net worths. And it has worked up until about 18 months ago, consistently, because now everybody is stuck. There's a lot of people that are gated. And as the woman 2 panels ago, I think, mentioned that they did just that. They had a $30 million investment that went to 1.5. They probably should have hit the bid, but there wasn't one. So now these sort of secondary trades or whatever, 30, 40% down. So I think, I don't know, everybody seems to think that the election matters or not matters. I think the political spectrum is just, the twilight zone. At the end of the day, financial services guys, and specifically, people working on M&A and credit guys, they're like, I had an old timer once say to me, he's a very successful Wall Street guy, that he doesn't read the news and doesn't watch the news. I said, well, how do you do it? He goes, because it interferes with pattern recognition. So I guess maybe the best way to handle what you want to do going forward is just to not watch TV.
Or read the news. I have just one more question regarding election items, and then I'm going to probably move off that topic. I can understand how the interest rates affect the logjam, and everybody knows that interest rates going down. We just heard about the advent of private credit coming into the marketplace. So there's a lot more access to capital, but there is a chance that cap gains rates go up, that carried interest for private equity firms go up, and maybe the chances of those are higher than they have been. What happens if that happens?
I mean, again, it's the twilight zone, right? I mean, people talk about a wealth tax. I mean, you never follow the French anywhere, let alone like a wealth tax. And look, there'll be a massive market sell-off, right? There's no question, right? People realize their gains, get ahead of the tax. Forever, politicians always say tax dollar policy doesn't affect, people's behavior. Well, tell that to Florida and Texas and Nashville, Tennessee, right? So, people, hopefully we're sane enough to make that a low probability event. In the case that we don't, I think everybody's going to run to cash.
I'm going to go to you next, Roman. Given that we just had the discussion, do you agree with that?
I do. I think the challenge is going to be, if you look at it, it's almost like it's going to be all or nothing. So if you look at it, you look at the policies that have been put out there. if we end up, with the Democrats in the White House, guaranteed they're going to push for, the carry interest loophole to go away. They're going to push for increased capital gains. They're going to push for an increase in the corporate tax rate. But at the end of the day, and there's going to be market reaction. You're going to have a huge sell-off. People are going to look at it. The difference is you're still going to have gridlock in all likelihood, gridlock in Congress, which means it's going to be very difficult getting this done. So I think what you would see an irrational market reaction that will remedy itself once people realize, okay, that's great, and these policy stances are what they are. They're stances. Actually getting anything done is going to be incredibly difficult.
Right. And just to counter that, if you take the flip side, if Trump wins and then he wants to go in with to create a smaller government, it's unfortunate because I think all of us, should be in favor of a lot more smaller expenses going on from the government side. But that heroin has been in the market for a long time, and everybody's addicted to it, whether they want to admit it or not. So if he goes in there, so if she wants to go in and tax money out of the market, that's one thing. And if he wants to go in there and stop the federal spigot, right? I don't know how the two coincide. Either way, I think inflation stays, right? And inflation is and we can get into inflation in regards to M&A and returns and all of that. But I think all of us are in agreement that politicians can play all the sleight of hand that they want and gaslight us like they did last night all day long. At the end of the day, inflation is impossible for any politician to hide. I mean, you could be Gandhi and you will not get reelected if there's inflation in the system, because women going food shopping notice that every week something's 20 cents, 40 cents, 80 cents higher. And the vast majority of people in this country are on budgets. And if their butter is doubled, you can't hide that. And you can't gaslight people away from thinking that exists. That's another question, right? But they did keep the tariffs, as he said, and I don't know if that's followed through with steel prices. But I don't know. I haven't done enough work on that to know if steel actually has,
But if you cut the cost of energy in half, tariffs kind of pay for themselves.
Exactly.
All you're doing by increasing tariffs is you're not letting China get the alpha from cost of energy. But actually, I had a question about energy. If let's say Trump was elected and so that makes more energy companies are more amenable to more eliminate or thoughts.
Yeah, I think it's difficult to say at this point, but definitely I think we would expect less regulations from the government in the field of oil and gas companies. What we've observed, certain regulatory issues and hurdles in the oil and gas M&A, in the energy M&A last years.
Right. So historically, energy has been about 10 to 20% of the public markets. About 4% right now. And so it goes back to historical trends. You expect to start doing more M&A.
Right.
Theoretically, yes. I mean, it's really, when you look at, when the government starts touting, whether it's areas in healthcare, where it's pushing dollars to manufacturing, whether it's pushing dollars to infrastructure, it's going to drive transaction activity, whether it's private equity activity, merger activity, consolidation within the industry. So you would think if there is a push towards any one particular sector, that you would see an increase in the level of activity.
Short term, if it's artificial. There's been, today there's been a lot of talk about family office investing, different strategies, what makes a good investment, what they focus on. So Roman, I'm going to turn to you for this question because I know that you work with a lot of family offices. Is the M&A environment better or worse for family offices now?
So I don't think that the current environment is good for any buyers on the M&A market. And to engage the audience, I see like a lot of representatives of family offices. How many of you have done M&A deals like this year? So according to PwC recent report, there is a rise in family office M&A, And they think they're competing with other traditional buyers because of two features. They have longer holding periods, so they basically can go through this unstable times, and actually unstable times is a great opportunity for family offices. And second, they have more flexibility in terms of how they invest, because they don't have more written investment policies. They don't expect high returns. That's why, I mean, according to PwC, there is a rise in M&A. I think in our practice, we have seen more M&A deals in family offices. And if you look at big law firms, actually they're building family office M&A groups. So this means that if they're building these groups, there is M&A work, there is M&A activity in this field. And you also asked about cross-border M&A activity of family offices. We see two trends. One trend is we see international family offices coming to the United States, and we help them actually set up the structures, the presence in the United States, the LLCs, through which they basically invest into the US market. And another trend that we see for our US-based family offices, so they acquire assets and make direct investments in the industries that they are very familiar to them, and then do add-on transactions outside of the United States. We just had a client who acquired a company in TMT sector and had a follow-on transaction in Germany and bought small asset there in the same industry. So this is a trend we're observing.
And to just to go along with that, family offices typically have made their money in some concentrated position in a company that they own. So there's kind of a history of being an owner inside some of these families. So as opposed to PE, who has to answer to either their limited partners or members in whatever their vehicles, as Rome said, the duration for these guys is longer, but they have somewhat of a culture of operating businesses, right? So and it's very interesting to see where America is today in terms of just being a picked over spot. I've got two anecdotal things. Youth sports teams, there's people rolling up youth hockey clubs, youth baseball leagues, right? Because these parents are spending, yours truly, are spending a fortune doing this thing with their kids. And it's kind of an interesting thing because the DOJ or no one will ever go in after somebody if they own every sports team in the tri-state area, right? Another one is anecdotally, a friend of ours, brother-in-law is in Maine, and apparently a family is up there trying to roll up a family lumber, tree farms, right? His neighbor has gotten 4 phone calls trying to so it's a very picked over space, but these family offices have a history of owning, operating, and understanding cash flow businesses.
So what we've seen as well, divestments in this position, conglomerates are just getting rid of, parts of it that don't work, or they don't provide the necessary cash flow to price it.
And what's interesting about that, not to chime in again, but
For the last 2 years, that's what we've seen.
But what's interesting about that is that from a family office perspective, or even PE for that matter, right? A large conglomerate can sit there and be like, this business that does $4 billion a year is really not accretive for us, right? And then you're sitting there going, are you kidding me? And then they just be like, yeah, we got to get rid. To your point, they just got to get rid of it because it's a drag on the balance sheet for whatever alchemy we don't know. And a family office or somebody could pick that asset up, and it's a very good livelihood. It's a business.
But we'll often have to go to former executives and say, hey,
Yep.
will you buy it out?
Yep.
And then they kind of give it away. I mean, we actually had a healthcare company come to us that Zoom was given 80% of the company to run. All she had to do was raise $20 million. But it had $100 million plus invested in it, but it wasn't performing, and the company retained 20%. So we see those deals, the last couple of years.
So I've heard some bad news about the M&A market. It's election year, down year. Interest rates are still high. No one knows what's going to happen. Why are prices still inflated? Why are assets still inflated?
It's a legal question. Legal.
I'm expecting an answer.
But we definitely see on now deals, M&A deals, how party sellers and buyers try to basically bridge a gap in terms of what seller is requesting for the company, and what buyers request. I mean, and they use basically from the legal perspective, well-known mechanism of earnouts, where basically if you can agree on the price now, let's put a portion of the price as a deferred consideration, depending on performance, how the company will perform. And although in this case, performance is not purely dependent on performance of the company, it also depends on all these like macro factors, which basically influence the industry in total. And what we've seen as a recent trend that sometimes traditionally you've seen like 20% of the purchase price deferred because it's like 20% gap. Now we see like 40, 50%, which is quite a high amount that is being paid later, depending on the performance of the company. And it led to the rise actually of the earnout disputes. So Delaware courts are now flooded with earnout disputes where basically we see that sellers aren't happy with the earnouts that they don't receive because the way the buyer operated the business, and they think the way the buyer operated the business led to the decrease of the earnouts, and they didn't actually achieve those criteria that triggered the earnouts.
So I think that, so did everybody get that? Go ahead.
Well, pardon me, I think it is a slight issue with your question. Interest rates are still high. I remember when the Fed funds were 21%.
Right.
Historically, interest rates are not high.
Right.
Which is higher than they have, but higher than zero.
Right.
Artificial.
Right. Right.
They're higher than where everybody modeled rates in when they figured out what they could afford to pay for a business, which, you're exactly right.
Back row, and then we'll go to you.
Public company earnings multiples pretty historically high as a cost of equity. So they drive more M&A. M&A hasn't actually been generated return on public companies. This is more.
That's a good question.
M&A for what sector?
So I think what I've read is that you're right, that a lot of these big conglomerates do get into these, like I mentioned before, that they're serial acquirers and then serial divestors. I think part of that has to go into the ecosystem of some of these companies where you don't know what's driving people's incentives to buy certain businesses, right? Because, there's opportunities to buy something at, 300-400 million, and then the company will say, hey, when it's worth 4 billion, let me know because I can't make my bones at P&G unless I buy a $4 billion company, right? So you don't really know how a lot of that goes on, but I think the numbers on an aggregate level, to Marty's point, I think on an aggregate level, you could argue that the whole thing is kind of a little bit of a shell game, on it from returns. But I do think that there are some successful mergers, and roll-up strategies that have occurred, for sure.
I mean, the tech company.
Yeah, the tech company.
The big 6 or 7.
Yeah, I mean, when Facebook bought Instagram, I mean, who knew that Instagram would turn into that? And then you get into those kind of strategic moves. The tech world's kind of a beast to itself, where they buy companies not for the product but for the people, right? So I don't know how you. Yeah, so I don't know how you get a metric by buying something to take it off the shelf, right? So.
Well, but it actually, because it can scale so easily, stuff that looks expensive actually is cheap because but they're scaling, and people don't realize their scale, right?
Infinite scale.
The
Yeah.
scale is, and they have so much cash. One has 100 billion in the bank, right?
Mhm.
But there's a difference between public M&A and private M&A, firstly. So I wanted to direct this question to Jeremy. So for private equity roll-ups, the firms that you are working with, are the bolt-ons accretive?
Predominantly, yes. I think even in this market, I would say yes. We are working on one right now. I'll just give this as an example. And, it's too early to tell if this one will be accretive or not, but, it's a portfolio company of a private equity client of ours that is buying a business that the business they were targeting was expected to do $10 million of trailing 12-month EBITDA at the end of August. They came in at 7.5. So the deal's been recut. At the end of the day, the enterprise value, the total purchase price hasn't changed at all. Structure has changed. So cash at closing is down 40%. There are now 4 earnouts in place, 4 different earnouts in place. There's a seller note in place. So it's almost a structural shell game. But at the end of the day, when you look at it, you're saying, okay, well, I think you're still paying the same amount for that business because the enterprise value is the same, but you're not. You're putting a lot of the risk on management. So it's the private equity firms that we're working with, they are, from a financial engineering perspective, exceptional. They're going to look at a deal, you're going to run the numbers. And in order to get the deal done, you have to hit the bid on the enterprise value purchase price number. We're going to work and figure out a way to structure that deal so it is still going to be accretive as an add-on. And when you look at this business, even if the business performs and they knock the ball out of the park and they're achieving the maximum purchase price for this business, all in when all the earnouts are taken into consideration, based on the way that the numbers are working out, they're still dollar cost averaging down when they look at the total portfolio company. So the short answer is, in almost all these deals, unless the business falls off the face of the cliff or face of the earth, yeah.
So I know there's a question. Go ahead.
I just want to make an observation relating to the 21% versus, 5% interest rate, hurdle rate, that situation. The difference is in the leverage and all the structures. You have to think of it in terms of risk, whereas 21% may not have as much leverage in the deal or cost, whereas now deals are so levered, and then stock market multiples are even further levered, that these small changes in interest rates have a big impact. It's all due to leverage. The better way to think about it is comparing risk to risk.
Right.
The rate.
But it's a good point, but and the 21% may have been before this time period, but has leverage on deals been decreasing over time? Have firms been putting more in equity? I don't know, 10 years. What do you think?
From my perspective, it's, if I go back to deals that I did 10 years ago versus deals I'm doing today, total leverage hasn't changed.
Okay.
I think it's, it's been high for quite a period of time. I think the question is going to be, what was total leverage back when rates were at 21%? Was there a private credit market back when rates were 21%? Because I tell you right now, if there were a private credit market and rates went up to 21%, there would not be a private credit market.
And I would add that, at the end of the day, the M&A guys, to your point before about people's spreadsheets and you're inputting the numbers, I mean, these are serious financial modeling guys, right? And it's a particular business and they really get into the weeds. And so when they create the capital stack on how a deal gets done, what they're taking in, like they have modeled that out, right? They've modeled out what they want to do with equity, what they want to do with debt, and how they want to get that all structured. And then they have to take it to where they're getting to the financiers of the deal as well to make sure that that's all amenable. So it is actually serious work that everybody has to do in order to get a deal done.
And let me just go back to one comment I made when I said, not much change in leverage. I'm talking about within a band. If you look at, call it between 5 to 7% total, 5 to 7 times total leverage, we've been in that band. There's some peaks we're going above that. There's some troughs where we'll go below that. A lot of it's deal specific, a lot of it's industry specific. But when I look back, within that band, it's been somewhat consistent. You will see fluctuations, but not, we're not going up to 12 times anytime soon, and we're not going down to 2 times.
And people are maybe, if asset prices are still being inflated, people are making up that with innovative structures.
Right.
So let me continue on that path, because this is some interesting things. I want to give people some tools out in their toolbox for M&A that they may not have. We talked earnouts. What other things are people doing to get deals done?
Yeah, maybe back to the point with leverage. I think that in the family office M&A, this is actually our panel, I think we probably have seen less leverage on these deals, and that's why they're saying that with family office M&A deal, you have more certainty. The deal will close because it's not dependent on that, and this is actually what attracts basically sellers, because they will not sign term sheet and then basically see buyer walk away, because And these deals are done much faster than other deals because they don't have like formal investment committees that we see like in larger buyers. And to the innovative structures, I mean, we don't have like SPAC structures or similar structures that were popular a couple of years ago that I think will be used in future. But I think that family offices are definitely more creative in terms of structures they use. And I feel like depending on assets, like even like real estate investment, you come up with creative structures for each deal, like case by case basis. And in terms of general M&A, I think what structures we see is add-ons in private equity, where basically after acquisition of the portfolio companies of an industry, you see small acquisitions in the same industry where small companies are being acquired to basically supplement and complement the portfolio company business. And another trend maybe with family offices, I mean, they traditionally invested through third parties, through private equity. Now they're trying to join club deals. You see them like co-investing with private equity investors. And then they're basically starting to invest on their own, right? So you see them like as angel investors, as VC investors. I think Ben is our partner, does a lot of VC work, probably sees a lot of family offices competing with other investors for VC. And I think they're probably more attractive because they don't expect higher returns. They're less formal, they move fast, and they make fun, and they like people. Like, I like that guy, and this is how basically an investment is made. So,
do they not like private equity people? Okay, so a good segue into family offices, creativity and some advantages. Give me some tools besides earnouts. What else are they doing to get deals done? I'll tell you one I've heard. Forgivable seller note. Has anybody ever heard of that? Okay. I never heard of that until 2 weeks ago. I can't even believe that's a thing. So apparently, obviously, people know what a seller note is. And well, tell me what you've seen in the market.
yeah, please go ahead.
So can I give a quick anecdote about?
Yes.
Earnout. So I was on this similar panel to this with a bunch of lawyers, and they're all talking about contingent valuation price, earnout and things. And about halfway through the presentation, the guy in the audience stands up and says, "What is an earnout?" And my fellow panelists said, "A litigation in preparation."
Right.
I mean, you know, any alternative, you know, as a lawyer, you know, like representing sellers, it's like the last thing we want to do. No matter how good it is, no matter how specific we are, your resources are going to get cut. You're not going to get your milestones. You're not making that. So yeah, you know, a lot of us are, I mean, open to creative ideas from the audience how to solve this problem. But the forgivable seller notes is one of those options, basically providing capital to, you know, people on the cap table, maybe the CEO. Basically, there's mechanisms built into it.
Right.
And if you, I don't know if you guys heard, when Aviation Gin traded, apparently Ryan Reynolds had a few coarse words for everybody in the room because he thought he was done, and then somebody educated him on what an earnout is, and he went in and quickly apologized to everybody.
Good story. Well, I'll go for you, and then I'll go the back first.
And then big capital budget, so one to grow.
Okay. How would you give me a little definition of a big management incentive program? Is that like a pool of equity? Is that, you know, what is that?
Yeah, it's typically cash payout.
Okay. Got it. Okay. Front, go ahead.
Put money in investment account based on what the seller is going to get if certain performances occur, and then either increase it or decrease it based on achievement of those performances. So that's one way to mitigate the burnout situation. Among other things, I could probably dream of to get something that makes sense.
Okay. Good. Any agreement with that? That sounds good?
Yeah, that makes sense.
And in
Okay.
terms actually of earnouts, we represented one company that basically, family office that basically sold their business. And they had like very creative earnout structure. As I said, like it was like maybe 60% of the total purchase price is payable within 3-4 years, depending on the performance of the company. And then the buyer breached the covenants, operational covenants, that buyer was supposed to comply, keep this company standalone. The buyer made full integration into its business, breached all covenants. And basically parties had to negotiate as a part of settlement the earnouts. And then we looked into other acquisition of this buyer and we noticed that within 2-3 months after the deal was closed, they were signing amendments to the purchase agreements where instead of long-term earnouts, they paid some kind of like lump sum to basically replace this long-term earnout structure and pay a certain portion of the purchase price, which is like trends showing that basically these earnouts, they're leading to litigation. They don't work. They depend actually on the buyer. Buyer will act in good faith in basically running the business. And if the parties didn't find, they had a gap on purchase price at the time they closed deal. A bit later, they're probably more flexible, agreeing on the fixed price rather than having long-term earnouts.
I would have calculated already in advance what is the potential growth of that company? What's the valuation going to be going forward under certain conditions? I mean, I'm not giving an earnout because the seller looks terrific and gives me a song and dance. There's got to be conditions. And I have to determine that, not me personally, but the buyer has to determine why am I giving that earnout? What is it going to be based on what I think can be achieved? Not what he tells me he can achieve.
Yeah.
Okay, so it's on me, the buyer, to understand what I'm buying and what the potential of that is. Otherwise, if I'm gonna buy something that ain't gonna be worth any more than I pay for it, why am I buying?
Yeah, that's why they
You gotta be
basically
right on what you-
they wait for the performance of the company post-closing. They calculate EBITDA first, second, third year post-closing, apply multiple that they agreed in advance, and make payments. And the problem is that this EBITDA is just not met. It's not achieved. And then the question is why it's not achieved. Is it some macro factors? Is it because buyer did something wrong? And I think these agreements that when we represent buyers, there are some covenants that basically allow sellers to claim that they were breaches and that if buyer didn't run business differently, then these earnouts would be payable. So I think the point with earnouts, it's a good way to bridge a gap, but it's a path to litigation and future disputes. So,
And like, I, from what I've seen, and I don't know if it's widespread, but you tend to see a lot of earnouts in consumer deals, right? So you've got a founder who has built out a brand, right? And that brand is doing very well, whether it's cosmetics selling through Ulta or True, with True Beauty or whatever. And you take Selena Gomez's thing, like the other day, right? I mean, who knows? Or you got the spirits business in particular. And those companies typically don't have the balance sheet in order to go to full distribution, right? So like we're invested in a whiskey company. It's done very, very well, but I can go to a lot of liquor stores and a lot of bars and it's not everywhere. Like Maker's Mark's everywhere. It's in a bodega and it's in the Four Seasons, right? So like what happens is the acquirer is typically the distribution. You saw that with Cisco. Like Cisco used to make their own stuff. Now they just buy stuff because they have widespread distribution. But to your point, Roma, it's the seller is telling the acquirer that the brand has this much strength and this much EBIT and all these kind of things. And the buyer saying, fine, we're going to put it in full distribution. And then it's a jump ball to find out if it actually, if you see the follow through.
How do you control the cost relative to the revenue? Because if the costs go up, either it's going to go down.
100%.
No matter what. So no matter how much revenue he is able to bring in, if he can't bring it in on a cost-effective basis, his potential earnout goes down. It's got to happen just by the numbers. So you have to then determine how do you structure that deal, given the fact that either the revenue can go up because prices went up. Had nothing to do with him.
Well, and EBIT can go down because a larger company typically allocates SG&A like uniformly throughout the company, right? So you've got some company, they're running lean and mean, they're running 62%, EBITDA. And next thing you know, you get stuck into this conglomerate and you're getting all these allocations for real estate or, property taxes and all this other stuff. Next thing you know, it's a 35, percent operating margin business,
We
so.
just went through a situation like that, and the solution was, it's not very creative when you think about it, but it actually was a little creative. It was a 4-year earnout structure, and then because there was a lot of expansion that had to happen, they did the first 2 years of the earnout based off of gross profit, and then years 3 and 4 based off of EBITDA. So once things got normalized, and they would grow into that EBITDA number. So I think, in terms of structure, we're starting to see, a little creativity, a little flexibility, nothing earth shattering, because it's just another earnout, and it's just, breaking it up, whereas historically, you'd base it off one number and you'd kind of just roll it forward. Now they're, getting a little creative, looking at different ways.
You might be able to do it on earnings and adjust it for inflation.
Yeah, depends on the business. It's a negotiation.
That's a great subject to take offline. So, thanks so much.
That means we're done.